Hello there, everybody. Welcome back to the YouTube channel. This video is all about property investment, the tax side, the account side, and it's aimed at beginners. So, anybody who's looking to get started in property or is just starting their journey, essentially what you need to know investing in property in your own name, limited company, key accounting dates, tax write offs, and everything else that you need to actually fully understand what investing in property is like and the most tax efficient way of doing things. So, who's it for? New property investors, those starting out looking to scale, and also established investors who are just looking for a refresh on the basics. Who am I and why should you watch this? Well, my name is Joshua Tharby, Chartered Tax Advisor, Accountant, founder of JSM Partners, and we're a property specialist firm of accountants. And again, since 2018, believe it or not. And since that time, we've worked with probably thousands of property investors along the way. We've still got hundreds of regular clients, thousands over the years to help them get things set up in the right way and pay less tax. The question that I get asked most often is, should you buy property in a limited company? Here we've got the essentials of investing in your own name. So you've got your profits plus the mortgage expenses are subject to income tax. So this is the Section 24 rule that a lot of you probably know about, or if you don't, essentially you don't get a full tax deduction for your mortgage expenses when you invest in property in your own name. Now, the downside of this is when you pay tax at 20, 40, or 45%, you actually only get a 20% tax credit for your mortgage expenses. So if you're a basic rate taxpayer, not too much of an issue, but especially if you're claiming child benefit, you're a 40% taxpayer or 45% taxpayer, well, actually you pay a hell of a lot more in taxes because you're not getting the full tax write-off for that mortgage expense. So really, for most people now, it's not best buying in your own name, and it's really only suitable for those with lower earnings, well within the basic rate band, and you only want a small number of properties. So if you really are, for sure you're going to stay in the basic rate band or potentially just over, then buying property in your own name isn't too bad. But for everybody else, if you want 5 or 10 properties, you're in full-time employment now, buying in a limited company is going to be the best option. So how does it work buying property in a limited company? Well, profits after mortgage costs are subject to corporation tax. This is very different to the previous slide where it's actually profits plus mortgage expenses subject to income tax. Actually, here in a limited company, you do get a tax deduction for the mortgage interest. And the rates of corporation tax were a little bit confusing. It used to be a lot simpler, but now it's 19% for profits up to £50,000, 26.5% on profits between just over 50,000 and 250, and then 25% over 250. And if you do have other limited companies, these numbers are basically divided by the number of associated companies you've got. A little bit technical, but for most people who are just starting in property, you've got one company, these would be the rates of tax that apply to you. The good thing about a limited company is, as you can see, for a lot of people where you are earning good money, either in your own business or through employment, the rates of tax are a lot lower in a limited company, which of course leaves you with more left over to accumulate and invest. And with a limited company, there are inheritance tax planning opportunities as well, using family investment companies. Definitely beyond the scope of this, as this is aimed for beginners. But if you do want to learn more about setting up a company to be optimized for inheritance tax as a family investment company, we've got tons of other videos on that. But for people just starting out, you might have 50 or £100,000 to invest. It's probably not worth looking at a family investment company yet because of the cost of setting those up. So you'd want a normal standard limited company. Limited company mortgages, I'm often asked this question, and to be honest, they are really readily available. A lot of people think that they need a trading history. The company needs to have been set up for a long period of time to get a mortgage in a limited company. This doesn't really have any impact whatsoever. They lend against the asset, the rental cover, and as long as you tick those boxes, you can get a mortgage in a brand new limited company. Typically, you can get the 75%, potentially even 80%, but 75% is the most common. Rates of around 4 to 4.5% is what we're seeing at the moment. The 25% initial deposit, so where you're starting with a limited company, you can borrow 75%. So the 25% deposit, the solicitor's fees, stamp duty, any refurb costs, that's going to come in from you as a director's loan, and that's a loan from you to your limited company. You're going to pop that in, so that's going to go straight into the company bank account from your current account. And then when you complete on the property, you'll transfer the money from the business bank account to the solicitor, who will then complete along with the mortgage funds as well. And it's worth mentioning there that mortgage interest is fully tax deductible for a limited company. Setting up a limited company, how do we go about doing that? For anybody who's not set up a limited company before, it's worth mentioning a limited company is a separate legal entity. So you can't just take money to and from a limited company anytime you transfer money in and out of a limited company, usually it has tax obligations, especially once you've used up your director's loan account. The company money isn't your money. The company itself has to pay corporation tax. Then usually when you take money out of the company, it's got to be a salary, dividend, interest, or some other kind of payment, and there's usually a tax liability on that, unless it's just a straight repayment of director's loan account capital. So, mortgage lenders prefer a clean company used only to invest in property. Sometimes this is called an SPV. If you've already got a trading business, if you've got a hairdresser, you've got an accountancy firm, and you try and go and buy a buy to let property in that, that is going to be an issue. A lot of lenders won't like that because, well, actually, that asset, that property is mixed in with that trading business. And if somebody sues JSM Partners as an example, well, actually, that asset is on the balance sheet. So that they don't like any kind of danger or risk over their secured assets. So they want it in a completely separate SPV. The normal SIC code to be used for just buy to let investment property, or BRR 68209. And when it comes to setting up a limited company, you can do it yourself. If you haven't done it before, it might be best to get an accountant to do it for you, because a lot of people now even still don't know the difference between shareholders and directors. Often people say, yeah, I'm going to add my child as a director to the company because it's going to save tax. No, it won't. Essentially, shareholders are the people that own shares in the company, and that's where the value sits. So if you are setting up a company and you want your children involved and they are over 18, well, actually, yeah, you can make them shareholders, because as the property go up in value, as the equity increases, the value of those shares increase, which is usually what the taxable issue is. So inheritance tax is all based around shareholding. Directors, really, they don't have any involvement in the company. They're just essentially employees who run the company as an employee. They don't have any value. There's no tax advantages of having people as directors. It's usually just shareholders. Running a limited company, what do you need to know? So each year, a limited company needs to do the following: set of annual accounts, corporation tax return, confirmation statement. You'll definitely need an accountant to prepare your accounts and corporation tax returns. We've got a few clients that do the confirmation statement themselves. That's relatively straightforward. But for the annual accounts, corporation tax returns, you need an accountant. And usually they're done well within 9 months at the end of the year. That's when the company's house deadline is. But most accountants will probably get it done within 2 or 3 months after your company's year end. How are the profits calculated for a limited company? Well, pretty straightforward. Total rental income less all allowable expenses gives you your profit. Profit is taxed at the rates mentioned earlier. And it's important to note here, more expenses through the company, the less profit and the lower the tax bill. So this is where we think about claiming all the costs that we can. So we're going to talk about kind of use of home, things like that, company cars, pension contributions, and essentially doing what we can to make sure that we're capturing every single cost, so that the corporation tax and the profits are as low as possible, and then the corporation tax as low as possible as well. Expenses, what can you claim? And to be honest, anything that you feel is a genuine expense for the business, as long as you're not taking the mick, is usually 99 times out of 100 an allowable business expense. So we've got some good examples here: training and development, any courses, mentorships, things like that. Of course, management charges if you've got a letting agent, mortgage interest. If you do a repayment mortgage, of course, the capital repayment is never tax deductible. Same as if you're repaying loans generally. Actually, anytime it's a capital repayment, that is not a taxable event. There's no tax deduction for that. Any assets you've got as well, so phones, laptops, you're going to get a tax deduction via the way of capital allowances for that. So it's not strictly an expense in the profit and loss, but actually you're getting a tax write-off because of the capital allowances. Travel, 45p a mile for the first 10,000 miles, sourcing fees, salaries. But anything that you're genuinely going to incur to run that business and to make money is usually a tax deductible expense. The only thing you can't expense is business entertainment. Home office costs. There's two ways you can actually claim the tax relief for your home office costs. Easy way, £6 a week per director, no records. That's usually the quick and easy way. Or if you do spend a substantial amount of time and you've got a designated home office, there's an actually better way, which usually gives a bigger tax deduction, is you can rent your dedicated home office to your company. And simply you calculate the total amount of it costs you to supply your home office, taking into account Wi-Fi, council tax, all these kind of variable costs. And when you charge a rent to your company, that equals the expense. So actually, on your income tax return, you've got your income that you're charging the rent, charging your company for the rent, but less your expenses. There's no income tax to you to pay personally, but your company can give you that money tax free and also record it as an expense. There's a little bit of paperwork. You need an non-exclusive license to occupy, but any good accountant will be able to help you get this set up. Commonly missed expenses. So a lot of people, when they're just starting out, they use their personal card for everything. And this is a massive mistake because you lose track of expenses, invoices, and ultimately, because you lose track of that, you're not claiming it as a tax deduction. So you're paying more tax than you should. So definitely get a business current account set up, put as much as possible through that. Ideally, even if you're looking at Amex and Air Miles or things like that, get a business Amex set up so that you're getting your Air Miles and you're ensuring that everything is recorded in the business account. Another commonly missed expense is arrangement fees for mortgages. A lot of accountants get this wrong and effectively spread it over the 25-year term of the loan. But when you're actually taking on a mortgage and you have the arrangement fee to 2 or 3% that they add onto the mortgage, make sure that that's being recorded, because actually you don't see the cash leave the bank. It gets added onto the loan. So make sure that's being recorded as an expense. And if it's a material amount, you need to amortize it over the expected life of the loan. So if you've got a 2-year fixed rate, every property investor knows you're going to refinance, so you can spread that arrangement fee over the 2 years. Record keeping, definitely get set up with some software, Zero, QuickBooks. Spend a good amount of time, so whether that's weekly or monthly, depending on the volume going through the bank, reconciling that, keep all invoices and agreements. Legally, with HMRC and Companies House, you need to keep all business records for 6 years. Having it all digital and backed up makes it so much easier. And the better quality of your accounting records, well, the less your accountant needs to do and the lower their fees. When clients come to us and they say, oh, yeah, we've not got any bookkeeping software, our accounts are due in a month, we've just got some bank statements we can send you over, better believe it, there's a lot of work to do, so we're going to charge a high fee because we don't really want to be doing that work. We want clients that are on top of it because actually they're better clients to have. It makes our life easier. They're people that are serious about business, and it's just better for everybody. So as soon as your business starts to make money, how should you be taking it out? For most people, still the 12,570 is the most tax efficient salary. Anything over and above this, take as dividends. Every director or every shareholder gets a £500 dividend tax-free allowance. Anything over that is 8.75% in the basic rate band. And then as you get into the higher rate taxpayer, 33.75%. As we touched on earlier, directors' loans, if you've got one of them, make sure that you are charging interest because it's more tax efficient than dividends. And a lot of people can actually get 6,000 of interest completely tax-free from their limited company. Here's the most efficient way of doing things. If you can get a salary out of 12,570, a interest payment of 6,000, that's tax-free. You also get £500 of dividends tax-free, and then you just top that up with 31,200 of dividends at 8.75%, and that gives you just over £50,000 of income out of your limited company with just £2,730 tax. Obviously, if you're married, you've got civil partners, whatever it might be, those numbers are doubled as you're involved in the company. So actually, in the UK, you can get £100,000 out with a modest amount of tax, 5,460. Not too reasonable in the grand scheme, not too unreasonable in the grand scheme of things. But of course, when you go over and above that, the taxes do get a bit ridiculous. When you are taking money out, especially as a salary, do remember that you've got PAYE reporting obligations. Get your accountant to register you and submit the monthly RTR returns. Also, even if you do not have any of your income now, make sure you use your personal allowance because it's wasted otherwise. It's a use it or lose it allowance. So even if the company is making losses at the minute, get your company to still pay you a salary so that increases the losses in your limited company and increases your director's loan account so that you've got the money available to take out at some point in the future. Director's loan accounts, we're going to touch on those in a little bit more detail. So this is effectively the money that you inject into the company. It's called a director's loan. So anything from the mortgage deposits, refurb expenses, and really for property investors, the aim is to build the largest possible director's loan account as possible so that actually when you come to touch on the nest egg, for other people, they've got a business, they've got employment now, and the property side of things is the long-term play. It's their pension, it's their retirement. And what you want to do is try and maximize the value of your director's loan. So when it comes to actually you starting to draw down from your limited company, you might have a £200,000, £300,000 director's loan that you can just draw out completely tax-free rather than being pushed into the higher rate tax band. And of course, we've got all the different types of here. So if you sell equipment for its current value, salary you don't take, initial capital, dividends where the cash isn't paid, expenses where you don't get the cash, or the mileage is quite often put into the director's loan. And it's also worth mentioning that you can just take your director's loan account tax-free at any time. Charging interest on the director's loan account is very tax efficient because there's no national insurance compared to the salary. And you can also charge interest. Market value, typically we see between 10 or 20% because actually No one would lend money to a limited company, unsecured, no fixed payment terms. So realistically, you can kind of push it relatively high as to what suits your personal income tax and what gives you the most benefit. The interest on the director's loan account is tax deductible in the company, reducing corporation tax, and it is taxable on you. But as you see earlier, we had that £6,000 worth of tax-free interest, and that's made up of £5,000 savings nil rate band, £1,000 personal savings allowance. Anything over and above that will actually only be taxed at 20% income tax, which is a good thing to be paying 20% tax because, of course, it's tax deductible, where you're going to be saving at least 19%. So really, where you've got interest, you want to, and where you're charging interest, you've got a good loan, and the basic rates available. You want to be charging the highest possible amount of interest that you can. Tax efficient refinancing. So here we're going to talk about the BRR strategy. So a little example here: ABC Property, newly set up by Josh to invest in property and use the BRR strategy. 50,000 of savings will go into the company as a director's loan to fund the purchases. Josh earns 35k through full-time employment. So we're going to charge a 10% interest on this loan here, and that's going to basically be a £5,000 interest. That's going to reduce the profits in the company. However, because he earns £35,000 through work, we've not got that £5,000 personal savings allowance available. Only £1,000 is tax-free. But as we just mentioned, it's still tax efficient to charge that interest. There's only £800 of income tax on that loan. ABC purchases a property for 135k using a 75% loan, about £97,000 mortgage. Josh undertakes a refurb on the property using the remaining cash funds he loaned to the company. Now the property is worth £180,000. At this point, the property is remortgaged again at a 75% mortgage. So we've got a new mortgage of £135,000. And the new mortgage repays the old, freeing up about £37,000 of cash. And I wanted to just put this example in here because a lot of people think that if you're doing a refinance or you're remortgaging, well, you can see here, because we've increased the value of the asset, we've managed to free up about £37,000 of cash. And a lot of people think, well, actually, because there's cash, there's going to be tax on that, right? Well, actually, this is the best thing about the BRR strategy. Because you're just borrowing against assets that have gone up in value, that is completely tax-free. And this is why, for me, BRR is the most tax-efficient property investment and wealth-building strategy there is, because you can just add the value to the property. You can actually it's almost like if you sold a property, if you did a flip, but actually, as soon as you've sold that property, you'll pay corporation tax because you've actually had that transaction. But the good thing about BRR is you can pretty much get the same benefits as if you flip the property on, but without the tax downside. Because here we've got 75% borrowing against the property. We've not had to pay the corporation tax. Whereas actually, if you just sold the property on, you'd end up paying 25% so corporation tax, and you wouldn't have the cash flow. So really, BRR is the best way of doing things. It's the best way of investing in property because you get so many tax benefits in terms of you can continue borrowing as the property goes up in value and get that rental income. And then if you've been clever as well, a lot of those refurb expenses, you're probably claimed as a tax write-off. So it's going to be 2 or 3 years before the company's even paying tax on those profits. And if you keep refurbing more and buying more properties, it's almost a never-ending cycle until a lot of property investors won't be paying corporation tax when they're doing BRR for many, many years if you do it right and if you claim the maximum amount of expenses. The plan: continuously do this for 5 to 10 years, build a portfolio with the lowest tax rate, avoid taking income from your company if you're a high rate taxpayer, build up your director's loan account to maximize what you can take tax free in the future. Married couple, 100k with low taxes. Over this becomes a burden. And of course, moving overseas, as everyone is doing these days, whilst the company will always pay corporation tax in the UK, dividends are taxed in the country you're resident. So we've got a lot of people now that have still got UK property portfolios. Limited company is here, but they're living, mostly in Dubai, because that's where everyone's going at the minute, and they're able to get all of their profits after tax out completely tax-free through dividends. So if you've got any questions on what we've covered today, do drop them in the comments below. Or if you want some assistance with setting up your company, your ongoing accounting, just head to jsmpartners.co.uk/join. The call's also in the comments in the description to book a call with us and see how we can help you and your property business. Bye for now, guys.